ensure stable prices in the spring festival that is coming late this month in January. So a few in the market are talking about whether the PBOC are going to turn a bit more hawkish after this COVID wave, if there is a big pickup in activity and any inflation pressures that might be waiting in the wings to follow alongside that. But these comments suggest that they're perhaps more thinking about the now rather than the later, and that means they're going to continue on an easing path, if you like, or an easing stance, rather than turning a bit more hawkish. But regards to those comments, that seems to be the case. The comment on keeping in stable prices over the spring festival is maybe a little heads up that they're going to be keeping a tight grip on market moves and whatnot. So if you trade in $1, like a few of us often do, that may be something to keep an eye on if we get some wild moves in other currencies. But that's not doing an awful lot. That could present an opportunity maybe for a bit of a catch-up trade after that period. So it's just something to keep an eye on there. Over in Japan, PM Kishida was out again with more comments about wanting pay rises at a higher rate than inflation, saying that pay rises in line with ability will make firms competitive. We also heard from one of the big business lobby leaders, Kinderman, saying that achieving wage hikes centered on base salary that don't lag inflation is the duty of the corporate sector. Now, this guy, this lobbyist, is a big supporter of getting wages up, was pumping for firms to do so late last year. So it's all building up towards potentially seeing some wage moves coming into the end of the first quarter as we get into the end of the fiscal year and into the new one. Reuters repackaged up the Nikkei piece on the Bank of Japan raising or apparently going to raise its inflation forecasts. They were saying that their sources saying increasingly focused on core to core CPI engaging the price trend, likely to raise the fiscal 2022-2023 projections in at the next Bank of Japan meeting, which is towards the end of January. But they said that an upward revision in those price forecasts are unlikely to trigger an immediate interest rate rise. I think that's stating the bleeding obvious. And they may also slightly raise up the CPI forecast for fiscal year 2024, depending on wage prospects. So as I say, a bit of a repackage by Reuters coming out after that Nikkei piece that was the day before. Looking at some of the data, Japanese consumer confidence came in higher overnight as well, up to 30.3 from 28.6. So feeling a bit chipper going into the end of the year in Japan. We also had services data from China, as you can see there, a bit of a tick up, 48.0 versus 46.7 prior for China, still in contraction over there. But back to Japan. He's really pushing this, isn't he, Kishida?
Well, yeah, it would really like the companies to come up now with serious wage hikes. We've seen that. I can't remember for how long the real wages in Japan haven't been growing at all, right? So he's now really pushing for the companies to make a big effort to align at least with the CPI. I'm a bit surprised that dollar yen didn't move with anything overnight, because we've also seen that the monetary base declined by 6%, it's been volatile, right? We've been down to 131.5, but now we're already back at 132.5 in the dollar yen. It's I've got the impression a lot had to do with positioning, people looking for the 130 break, and then had 2 attempts and didn't materialize, and then got forced out of some yen long positions. I was off yesterday, but then I saw a Kashkari coming out at that time. He's going to be an FOMC voter this year, saying that he sees another 100 BPs hikes to bring rates up to 5.4-ish average. Was that the catalyst? Possible, but yeah, myself, I'm not sure. I mean, I don't see too much of a reason for these 200 points move higher. So I really think it's more positioning than anything else. And yeah, as you say, Kishida is really trying to push the companies to finally come over the bridge with decent wage hikes to give the Japanese employees something to cheer about, and probably the markets then as well. Per correlation, going to expect the Bank of Japan to be on the move soon.
Yeah, yeah, but it should be noted that even if they do raise these forecasts, it isn't going to mean an immediate switch to a hawkish stance or a hawkish stance, and they're going to start hiking the month after or anything like that. So if the market does get over hawkish into this, it's potentially going to get a slapped ass, because even these forecasts, even the 2024 forecasts are not expected to hit the 2% target. You know, we're talking 2 years down the line, over 2 years down the line. But a lot can happen. We have seen inflation picking up, and it has been picking up in some of the wage metrics as well. So, you know, the trend of higher inflation in Japan is there. It's just not rocketing like it has been everywhere else. But as with things in Japan, these oil tankers can move slow and steady for a long time. So we shall wait and see what happens there. Sorry, Kate, was you adding something there?
No, on Japan, I'm done. I just the one thing to come back on China, I think PBOC actually didn't add, but took out some liquidity overnight, and I think that may be one of the reasons why dollar China is a bit lower again, despite the rest of the dollars not really having moved a lot. And also, what else did they say? Yeah, they're planning seemingly on more targeted stimulus than really blanket stimulus. We're going to have a look at the dollar yuan, because there's a couple of really interesting levels coming up not far below here.
Yeah, definitely. We'll have a look at that most surely. Okay, right, back into it. Across to the Norges Bank, and they said that effective from tomorrow, the government has reduced its own stock of certain bonds from 6 billion NOK to 4 billion NOK. Now, I'm not going to draw any conclusions, but we did see some fun and games or strange moves in the NOK compared to what other commodity currencies were doing. I don't know if it's related. It's probably a 2 and 2 equals 5 sum on that one, but we saw the NOK doing some strange things yesterday, and now the Norges Bank have knocked 2 billion off their bond holdings. So, you know, maybe there's something in that. But anyway, that's the news from the Norges. Over to the UK, and PM Sunak is apparently going to be an ace inflation batterer. He's apparently going to halve inflation this year to ease the cost of living for everybody. I think he's playing the accountancy games, as Stel's been pointing out for a while. You know, for inflation to post high 8-9%, it's got to be that much over last year. And considering we're seeing a lot of last year's big inflationary moves in energies, that sort of thing, washing out, it's going to be tough to see those sorts of numbers. So, bit of an accounting, as I say, smoke and mirrors call there to see inflation dropping back.
The classic thing where they're going to take the credit for something they didn't do, but anyway,
yeah. Always the way, mate. Always the way. He's also apparently going to implement a strike law which will let bosses sack workers and sue unions. This is his fight against all the strikes that are currently going on, particularly in the transport networks here in the UK, really crippling the country at the moment. And he's been threatening to put in new laws to be able to fight these strikes. Likely, it's just going to lead to a bigger bum fight between the government and unions, and probably more pain to come on that front should those laws come into play. And going back to sort of China and typical Eurozone, apparently EU countries have failed to agree a united policy on pre-departure testing for travellers from China. Now, there is a bit of a worry that this COVID wave in China, Chinese people allowed to travel, that it's going to bring waves elsewhere. We're obviously in the midst of winter when such things can have a more marked effect, especially if we start getting things like different strains developing, that sort of thing. But as usual, the Eurozone can't agree, or the EU can't agree on anything between them. So by the time they do agree, we'll probably be in the summer and we've gone through everything COVID waves that may or may not come anyway. So as always, the Eurozone in a mess on that one. And as Kay mentioned, Kashkari was out yesterday. He had an essay out, it was called, on the goings on at the Fed and the economy. The main gist was that the Fed must avoid cutting rates prematurely and having an inflation flare up again, and says it would be a costly error to do so. He's seeing increasing evidence that inflation may have peaked, but it's appropriate to continue hikes at least for the next few meetings. Then the Fed should hold the target rate up, and says his forecast is that it will be at 5.4%. But they won't know if that is high enough until the Fed pauses for a reasonable period of time. And the Fed can only consider cutting rates when convinced inflation is well on its way back down to the 2% target. Now, I saw these comments. I was doing something else, but I saw these comments come out, and there wasn't that much of a reaction in the dollar outside of a 10, 15 pip move. And it was strange that we got this. It was, in my mind, a big yen sell-off, because all the crosses went. Dollar yen went. You look around at the clues, what's moving, what's not. Yields were doing nothing over that. The majors weren't really moving, 10, 20 pip moves in euro, dollar, cable, that sort of thing. Aussie dollar went a bit more, but it was really the yen pairs that made the move. And that has pretty much held up, but we have switched to maybe a bit more of a dollar bias, bid bias this morning. Take something like Aussie yen, it got up to the highs, it's now off the highs, it came down. Other pairs have hit highs and come off a little bit. So it switched a bit this morning, but it happened right after the data, the US data. And if we take a look at that quickly, the data wasn't all that. We had the ISM and JOLTS, which were the big numbers yesterday. And the ISM came in a touch lower on the headline. So further into contraction now. I think it was only by a pip. But the jobs number came in higher, went into expansion, 51.4 versus 48.3 expected. It was expected to fall further back into contraction. So it came in positive, which should take a few bears out of the NFP expectations for Friday, because there is an expanding number there. But as we can see, prices paid, another steep drop there, 39.4 versus 42.6 expected and 43 prior. And if you want to take a look at how this is getting on, it really is, really coming down off the highs. If I can get it up, come on, where are you? Wakey. Nope, it's not having it. Anyway, the high in this one was.
We want you to get it up, but yeah, carry on.
Okay, Steve. I'm not sure why that's not populating, but anyway, I looked at this yesterday, and the high in the prices paid was up in the I think 87 or something way back last March, and it's been coming down ever since. So this is now picking up a bit of speed lower in the prices paid, which obviously takes some steam out, potential steam out the Fed's hawkish stance, because they're getting their wish of seeing lower inflation. But a bit of a mixed bag, as I say, with this jobs number as well. We're still waiting for this domino, and it's a big domino, and it really is showing no signs of looking to topple over again. The JOLTS data as well was out, and there was higher openings or vacancies posted, 10.458 million there. It's only lower on last month because last month was revised from 10.3 up to 10.5. Now, given the time of year, November numbers, there could be a bit of seasonal hiring in these things and vacancies, firms looking for workers over the holiday period. So maybe not read too much into that at the moment. So that brings us on to the FOMC minutes, which could have been a bit spicy because we didn't hear from too many Fed members after the FOMC and into the end of the year. Usually we get an absolute flood of them, but to my recollection, we only heard from a few of them. Now, among the main comments, officials noted that the dot plot is tracking notably above the market expectations, and that the risk of inflation could be modestly persistent. Some saw that inflation risks were more balanced, but they generally saw that inflation risks is still a key factor. Many officials highlighted the need to balance two-sided risks. Now, one of the key comments that came out of this was that the Fed is, according to the minutes, wary of unwarranted easing in financial conditions, and it signals concerns over misperceptions of the reaction function. Very complicated way of saying that they need to be wary that the market isn't pricing as hawkish as the Fed are looking to be. This is something we have been speaking about since the last FOMC, this financial conditions. And just to reiterate the importance of those, if you have a central bank hiking and they're putting a level of where they expect hikes to get, you want the market and you want the economy to price into that effect as well. If you want to push a little bit harder, you go a bit more hawkish, the market might get a bit more hawkish and overprice. It does the tightening job for the Fed itself. But what the Fed doesn't want is the market to underprice the potential height of hikes, because then it's losing out on that tightening effect. Now, it's a fine balance for the Fed in getting the market to do what it wants. The market was on board going into the last but one FOMC. Then we had that meeting where Powell perhaps wasn't as strong on the hawkishness as expected. And then we had Jackson Hole, where he didn't really, push the boundaries of the hawkishness. He sort of seemed to indicate they might be taking their foot off the gas, not just in terms of hikes, but in terms of rhetoric. And we saw that repricing. We saw bond yields coming down. We saw the dollar coming down. And now that we've seen this in the minutes, I think we're in a position where the Fed are now concerned that the market's gone too far. There may have been concerns in the Fed. As we mentioned, we saw mortgage rates getting up to 6.5%, 7%. They perhaps were going a bit too far down the hawkish path. And maybe that's what Powell wanted to rein in the latter part of last year, not letting the market get too hawkish. But as I say, it's a very fine line, and it seems perhaps the market is now underpricing where the Fed could go, not expecting the Fed to get as high. And now they've got to face a battle of getting those expectations up a bit higher and getting that tightening priced into the economy a bit better. What do you think, guys? This sort of language it's always difficult for a central bank to get it right. It only takes a couple of comments and you reverse all the good work, so to speak. Is that what you think's happening here?
Perhaps what I want to say about the FOMC yesterday is that we are seeing the same that we've been seeing over the past month. So the Fed is trying to tell us they're going to be more hawkish than the market expects, but the market not buying it. And yesterday, Fed Fund futures, I think they ticked down maybe 1 basis point. So basically, nothing's changed in terms of what's been priced for this year. And this is both for the remaining hikes and the coming cuts. So the Fed is telling us, look, we need to hike probably more than expected and stay at that level for longer. And the market is going, yeah, don't believe you. Where's the risk now? The risk is for the market to at some point believe the Fed. I don't know how to say it, but there's clearly a rift between the two. And the bad thing for the Fed is that history usually shows that the market goes to price something and then the central bank kind of follows it. So I wouldn't be surprised if they do actually cut late this year. It will take a lot for them to cut, but I wouldn't be surprised if they do. But first, I think the risk is still that the markets kind of believe them a bit more and start pricing a little bit more before we see anything. Yeah, actually, sorry, I've just got somebody at my door. I'll be back in 2 minutes. Okay.
Yeah, no worries, mate. Kay, what do you make of it?
Yeah, I think some of this non-belief also has to be seen what's happening to the reserves as well. There is absolutely no issue with liquidity in the system yet. There's still a lot of reserves parked at the Fed for which they get free cash. The Fed is paying up for that. So we haven't seen any liquidity issues yet. And I think for the market to reprice, perhaps we need all those piles of forced or other reserves to be drained a little bit. And I think for as long as that doesn't happen, perhaps the yields are not going to fly high, and perhaps they will only correct at the very end when the Fed really hikes. For now, if you look at the 2-year, is right in the middle of the Fed funds. Is at Fed funds. The FOMC is at 4.25%, 4.5%, and the 2-year is there. So perhaps they will just reprice as the Fed goes, and then for the rest we'll see what happens to the real data to get the longer end running. But yeah, is the market underpricing? Yes, because the market expects still a recession and doesn't know what the look of the recession will be. So from that point of view, the market tries to underprice what the Fed is doing. Are they really underpricing it? I think so. But the market may be going, at least at the start of the year. Let's not forget we're still at the start of the year, and I know it's been a theme for the end of the year as well, because the dollar corrected quite sharply. People didn't buy sold dollars as the yields came off, as the recession fears went up. But at the beginning of the year, it seems the market is just waiting and seeing what the real data are going to show, and therefore we could have a pretty good indication tomorrow if the NFPs again do not come off. Then we might be in for a bit of repricing of the dollar here, and the more and the yields a little further down the curve.
I'm back, by the way, chaps.
Hey, thanks, mate. Did you get your surfboard waxed and the guy bringing it back to you?
It was food delivery, actually.
Oh, right.
We get some nice fresh fish here delivered at home. Really nice.
Mm-hmm. So yeah, I was saying the market could be more in a reaction function than an anticipation function just at the start of the year, because we are going to have the NFP out tomorrow, and then a bit later in the month we are going to see the CPI. So the anticipation has been sort of done with the longer end coming back, anticipating a recession, anticipating the Fed not going the full distance. But now the anticipation is done. The market will perhaps be more in a reaction than an anticipation function.
Yeah, I think you're spot on. And Brand makes the point. They don't know what to do if there is a soft landing. I don't think it's that they don't know what to do. I think this is what the market is going to be watching the early part of this year. Is it going to be a soft landing? Is it going to be a hard landing? Is it going to be a crash landing? Is it going to be no landing at all? Is the economy going to hold up and sail through the weakness that is predicted? And that's all going to play into what the market, how the market trades, the Fed, and these expectations. We're pretty much expecting, or a lot of markets expecting, a recession everywhere this year, at least in the early part of this year. We still don't know. I still don't believe we've seen the full effect of rate hikes that went up very quickly, particularly at the Fed. But if the US sails through this without much problems, then maybe we're looking at worst a flatlining economy rather than a big recession. As I put in that blog post, maybe 1-2% plus or minus throughout the year, not doing great, not doing bad, which in some circles will be seen as a win. And if that's the case, the Fed are going to keep their rates higher until such time as things turn markedly south. The problem they have is if the economy picks up while rates are up at 4.5%, 5%, whatever, and the economy starts heating up again, then what do they do in that situation? They might be forced to take rates even higher to combat a heating up in the economy. That's what interest rates are supposed to do in normal times. As an economy starts to heat up, you use rates to keep it manageable, stop it going too hot, stop it getting too cold. But we're in a wonky world these days, folks. We've got rates going up while everyone's expected to go into recession. Inflation's starting to come down, but still at lofty levels. All the rule of thumb books are out the window at the moment. But anyway, that's what we trade, and trade it we will.
Ryan, what I don't get is how employment is still doing really well, especially in the US. And all the while we read, I don't know if you read the headline, Amazon is going to be cutting a lot more workforce than was expected. What was it, 10%? I can't remember what the number was.
Cutting 17,000, I think it was.
17,000. Yeah. So everywhere you hear, there's more job cuts than expected. And still, the numbers are looking pretty good. Now, I think the question is, A, what's the quality of jobs that we get? And B, there's all this weird double counting of people having 2 and 3 jobs and all that stuff. There was an article I read. I need to find it again. There was an article I read some days ago that said that last NFP number was 200. I can't remember what it was, 200K, but the real number was something like negative 500 because there's all these mathematical things that they do and little tricks and double counting and this and that, and it's actually a lot worse than the number is showing. But I will find it and I will post it on the chat room actually.
That's been going on for months, right? This thing that they will have to reprice it sometimes, and could it be in the last non-farm payrolls of December of last year that we are going to have like one massive surprise there? And we were always saying like the labor will be the last big domino, and I don't know when it's going to fall to show the real recession, the real negative news for the dollar. But so far it hasn't shown yet, so it's going to be an interesting number tomorrow.
And what I would throw out, because we've seen it before, these bad weather storms in the US, they can impact the jobs numbers pretty badly. I think it was way back in 2014, 15, maybe a bit later than that. We saw some negative numbers at the year end. They were running at plus 200 or whatever. And we got, I think it was a minus 89, a minus 100 and something, because of these storms not enabling surveys to be done and people to register at jobs offices and that sort of thing. So these storms have been pretty bad. So either it might not get in these numbers, but it potentially might come into the January numbers. So that's something to stick on a post-it pad by the side of your computer.
Yeah, and do I not recall that we had like a separate report out in former year where they did all the corrections to the year's numbers, or did that come into the NFP report? I don't recall, but I recall that we had some reports in earlier years where we had those revisions come out at one stage.
Yeah, they I can't remember if it's with these numbers or with the January numbers. They do a revision report.
And I recall from from former years that we could have like really big revisions.
Yeah. No, you're right. That does happen, the yearly revisions.
So that is something to bear in mind there.
Yeah, definitely. Speaking of jobs, we've got the ADP coming out today, and we're expecting 150k versus 127k prior. Now, of course, ADP is never exactly on the same numbers as the NFP, but the market does look at it as a bit of a front runner if it's something that has a big variation. So always keep an eye on that in case it's a huge variation either way. If it posts a negative number or anything low down to zero, that's going to get the market a bit antsy ahead of the NFP tomorrow. So that's at 1:15 UK time, 150k expected. So jumping into prices, yeah, this move in the yen yesterday, very strange. I had no idea why it decided to run up 200 odd pips pretty much bang after yesterday's data. Certainly wasn't the data. Yields not doing anything much at all. Could well just be, although late in the day, could just be some Japanese players or people with investing in Japanese assets from the US or wherever, just coming on and doing some New Year stuff, seeing as they were only back yesterday. Either way, we look at the charts. The area that has resisted for now is up into this high 129s, 132s, 133 area. This was a big area I was watching on the way down. The fibs in there coming into play. We saw it holding pretty much just above. Then we got a little bit of action down here before we got the break. Then it came in as resistance around about this fib level and the 133 handle. Then it was support. Then we broke again. Then it was resistance. So this is the main area to note at the moment, in my opinion. If we've got something brewing in yen pairs and dollar yen, this is the area it needs to break. If we do, then we could get another move up to test the next zone 134, 40, 50, which again, form a support point, break point, then the resistance point. So all these numbers are stacking up. For the downside, this move here where we got the low and then we stepped up that low and we held above 130, which I mentioned, that could be a bit key, although I wasn't expecting it to attack on nearly 300 pips afterwards. But it's setting up the levels now for where we need to look at. So these two lows down here are where we want to be watching and see what happens in between. But this 132.90, 133.30 is for me the main area of resistance to watch up here. Aussie dollar, I had a little, I tried to buy the dip in this one yesterday at 68.40, got stopped out at 15 overnight. We're holding the big figure at 68, which does still keep these highs in the crosshairs. If we get under there, get under 67.70, then we're going to take a bit more pressure off these highs and they will solidify once again, and they're turning into quite a level up here. But while we're holding 68, we've got a bit of a range that might be developing here, and we'll see which way we want to go from that. I'm still interested in potentially buying a break up here. How I do that, I'm not sure about though. I might be inclined to stick a buy stop in maybe 69.20 and go for a proper break, or I may let it break, see if it flushes out, and then see if we get these areas down here holding a support. That'll be trying to trade the break with a confirmation buy. So sometimes when I look to do a break, I can go with a first move through, or I let the price do its thing. Maybe it has a little stop run, flushes out some shorts, then we come back down. If I start to see support at the broken areas, that's when I get a bit more better conviction that maybe we've got a proper break. We see support coming in and off we go again thereafter. I'm still keeping my longs here. But yeah, I'm really itching to see a break of this 69 area. What are you making of it, Kay, overall, or still, if you want to chip in as well? Are we just ranging for the moment, or are we looking to do something?
Well, we're ranging in, well, apart from the yen, which is volatile, we are pretty much ranging in what I would call majors for now. Yeah, still early days, and I think tomorrow, yeah, I'm really looking at tomorrow to give me an idea from where the dollar will go to into the CPIs, and that's going to be the first big number. We've done a pretty rapid move up and down in the dollar, but then and then up again. But now it seems we are trying to stabilize a little bit into the into tomorrow's labor report. That's really going to drive stuff for a week and a half, I reckon. And again, I would say, well, no, it's actually going to be a pretty binary event in my opinion. I was going to say a bad report will move the market more, but I don't think so. I think a good report could have as much impact as a bad one. A bad one would tell the market, like, yes, you were right not to follow what the Fed is telling us the past month or month and a half. But a really good report will have some heads scratching and needing probably to reprice a bit further down the curve, which is going to impact the dollar. So I really expect tomorrow to be a driver there.
Yeah, no, I agree with that. And I think you're right. I mean, if you look at something like euro dollar, we've come through the ECB turning more hawkish. We've come through the Fed doing its thing. We've got all this data. We've got all these yen moves. And here we are mooching around in a rough 100 pip range, outside of what we saw beginning of the year. We're not doing an awful lot, which, tends to indicate that the market in certain pairs, in certain areas, are well balanced. And that makes Kay absolutely right, that if you get big data, it's gonna be moving in a binary manner. So just as big on the upside as it will on the downside, depending on how the data comes out.
And that brings us to a few questions here that we have already in the Q&A. Horatio's asking, so with the famous phrase in mind, don't fight the Fed, and with the market not buying the Fed's hawkish rhetoric, what is the trade by dollar on weakness? I'll let you know tomorrow at at 1:31 London time, Horatio. No, really, I think that's going to be a pretty serious driver. And Harry Hindsight says that is probably what put dollar yen where we are now as well, is the market having to say, like, hey, hang on, it's perhaps not 100% euros the dollar, and see what happens. So that just for and what will it take for the dollar to make? And Charlie, what will it make for the dollar to make a convincing move up and down with follow through? It's exactly what we've been talking about. It's confirmation or information of what the market is expecting. So does the market continue to trade somewhere against the Fed? Because we are trading at pretty high levels in the euro dollar compared to the average of 2022 still. So we are going to know tomorrow, and then combination with the CPI, we are going to know a lot more. And about the euro dollar, what you were saying, Ryan, I think it's what we've been talking, what I've been saying at least on a few flow shows. And my view is for the euro dollar, of course, there's the dollar side, but the euro dollar side to be probably more stable than the rest, seeing the ECB trying to catch up on the rest. So, and I think that's where we are seeing, barring a few EM currencies, the euro crosses doing quite well on dips, and that there's a part of it is you can sell cable, you can buy dollar yen, you can sell Aussie, sell Kiwi or whatever, and the dollar moving up or down, vice versa, but euro dollar being stable because the euro crosses having a better time. So it's a bit logic, in my opinion, that euro dollars is more stable than the rest.
Yeah, and just to add to Horatio, you've got to think of it. You've got to think of moves in terms of like an elastic band, okay, you're always going to get a reaction and you're going to get an overreaction and you're going to get the market going too far. You know, you could say this about dollar yen, and we were saying it at the time. You know, this leg up here, 140s to 150, was a real push, and we got the intervention and that sort of thing. But it was looking like it was gone a bit too far compared to what the Fed were doing, what the Bank of Japan were doing, what the data was doing, that sort of thing. And so it was no surprise that we got this reaction lower. What was surprised that it went all the way back down to here. That's a huge move in itself. You know, it's done over 50% of that move. So when you're getting when you're feeling that things are getting a bit stretched up here and you're feeling that things are getting a bit stretched down here, you've got to think, well, where's the middle ground? Has the market got too dovish, the Fed, over this? Well, based on what the Fed have been saying as of yesterday in their minutes, they're thinking that the market has gone a bit too dovish in their thoughts, or less hawkish. So when you're looking to fight the Fed, you've got to know where the market was fighting the Fed in the first place. The market was trying to pivot all the way up here, trying to pick the pivot. When's the Fed going to turn? When's the Fed going to turn? And then it got the Fed cutting back on hikes. It got the Fed, some might say, not talking as hawkish, Powell, Jackson Hole, that sort of thing. And so the market took its money. It said, right, fine, this is where the pivoters are going to push the case, and they sent it all the way down here. Obviously, there was a little bit of Bank of Japan in there as well along the way. But then where's the price going to pull up? Where's the market going to push too far? I thought 133 is where it was going to push too far, and we went even further than that. So when you're looking at when to fight a market, or when to fight the Fed or not fight the Fed, you've got to judge whether the market has gone further than what it should have done. And that's when you start to maybe price in. That's why I'm always talking about looking at the big levels, looking at the range edges, looking where the price might stall and do something. Huge level up here into the 152s. We were pointing this out for weeks. All these big fibs, big long-term fibs and levels, going back, you know, decades. That was an area where I was looking at, if the Fed, if this move is going to run into some big trouble, that's where it's going to be. We didn't really get as high as that, but it held. Now we come down. I thought 133 might be the area. It didn't, but it's still showing up. So now we look down to the 130s, and we got even lower than that. So it's all about making a judgment call. You know, trading around the middle here on what the Fed might do, you're probably in a mess. You want to define levels where the price is going to spend a bit of time finding support or resistance. And when you get that build up of price action on a level, that starts to give you a key when you can then perhaps look to fight the market moves, or fight the Fed, or whatever you want to do. But as far as the saying, don't fight the Fed, you can say that about any central bank. I'm happy to fight a central bank if I have good reason to, and if I have good levels to. But it'll be the levels that judge that for me. Kay, do you want to take a little wobble around? Oh, sorry, Stel, you got anything you wanted to add? I did.
Yeah, I think wasn't Stel supposed to show some stuff today, or
was I?
I didn't actually ask him. I was going to just put him on the spot now, which you've just done. No, I don't know if you have, Stel, if you want to look at some charts.
I want to wait for tomorrow's numbers, really, to make some decisions. So I don't have anything new to say. You know, regarding my view on the markets, they are unchanged. So I think that late Q1 of this year, we're going to start seeing some pretty low inflation prints, and we did get PPI today. What was it? German PPI, wasn't it? Hold on, let me check again.
Yeah, coming off a little bit, still around.
And it is dropping, you know, from 13.5% to 27.1. So you know, we have been seeing ridiculous numbers, and they're dropping, and I think they're going to continue to drop fast. But before we see that in a big way, I still think the risk is for the market to kind of believe the Fed, and we get a little bit of a yield spike and dollar spike, and you know, I've talked about this extensively. Now, will we get that? I hope we do, because I really want to get in at trades at better levels than here. So I want to get short the dollar. I want to get long silver, a bit longer silver. I still have half a position long from just under 24, and you know, I am still looking at the low 22s to enter again. Now, will we get this move? I hope so. If not, I'm still going to get in, but unfortunately from worse levels. That's my view from kind of late Q1 for the next few months after that. Now, after that, all bets are off because I think that inflation will probably start creeping higher again. So, but nobody can forecast that far away, and definitely not me. But I just think, for the reasons I've stated many times, I think the inflation is going to start dropping, and I think there's going to be trades to be done to take advantage of that. So for now, I wait for payrolls tomorrow, which, as we said before, it's the last number that's still printing well, and it's showing resilience. At least the numbers that they give us are showing resilience, and if that starts to fail, then I think we're going to see the Fed turning around quite quickly. Not necessarily, getting in and cutting rates, but I think you're going to hear the language change a lot, which really is what the markets are waiting for, or maybe anticipating. But for charts and stuff, I really want to see tomorrow's numbers, tomorrow's move, because it is a big number, and then I'm going to make some decisions.
Cool. You have the Eurozone's penchant for can kicking, mate.
The dog ate my homework. Yes, Bran, thank you.
Right, just before I knock it over to Kay, I just want to have a quick look at the $1 myself, because I am in a little long here. I've got to stop at 687, which looks like it's more likely to happen than this thing jump. For me, the next main level is that fib you can see on there, and down into that area of lows there. So talking 684, 84 and a half, that sort of area. If we get under there, then we're heading for another big number down at 680, which was a bit of a historical number going way back through the years. So that's what I'm looking at for $1 for now. But I'll let Kay take the screens and things in more detail.
The six. I'm not going to show $1 since you showed it. The 684 is the 50% of the whole move up, right? So that's going to be a decent level to monitor. I'm looking at the time. We're already well into thing. So this is one to keep an eye on tomorrow. I think the short term as well, of course, but. If you talk about labor market, you can also have a look at the longer end, at least the biggest one, because this is going to be the main mover for dollar yen tomorrow. This is where it's going to happen, in my opinion. If we start to get back above 673, 373, 75 in the tens after tomorrow's labor report, then we may see repricing back up to 394, 4%, in my opinion. If in turn we start to see that domino falling again, then I think there may be a rapid move back down to the prior lows that we've seen around those 340s, which will be equally important. So for me, tomorrow, this is going to be the number, and those yields are going to be really drivers for where the market is taking us tomorrow, and then and likely into next week as well, ahead of the CPI. On the currencies, euro dollar, really, I mean, it's looking like a mess, and it is a bit of a mess. As I said, I think we're in a bit of a stalemate here. It looks that we are trading rather ECB together with the Fed now versus the rest. Euro crosses are moving quite a bit, but after the initial moves that we've seen over the start of the year, this is stalling now a bit. And to me, there's a pretty interesting zone around here, which is 105.18. It's the low that we have seen the first day of the year. And also there's a bit of a trend line coming in around 105.30. So that's going to be the indicator, the first decent indicator for the start of the debates on the euro dollar, if we get that much. And then the top side, of course, we are talking again about 107. And then there's an interesting one here, and I think I have to go to the dailies or even further out. No, here it is. So this whole move down that we've seen from 2018 into 2022, the 38.2 is around 106.90. So I think that's another one that we may keep an eye on. But as I've been saying many times, to me the real clincher for the euro-dollar move is going to be this red line. It's more like a zone, because we've been holding around the 108, 108, 108, and then bouncing, and then so this whole 108, 108 and a half, 109 zone is going to be, to me, the decider ultimately whether euro-dollar moves back up or whether everything is done and dusted and the correction is over and we are going back down for a much more medium to longer term. That is the big zone that I'm monitoring myself. Cable, bit of yo-yo as well, as we see pop. Once the moves have been done, we're stalling a bit here, 119.90, and then interestingly, this short-term trend lines seems to be capping the debates right now. So that comes in around 123.75, 80. Keep an eye on that one. And then the 121.10, 40, 45 zone, that's an interesting one to monitor, in my opinion. I've tried to counter trade this bounce just for a little. Sorry about that. Hang on. Just for, it's really small, but if it trades up above here, I'll be gone. In the meantime, I'm trading it actively around, having already improved my average a little bit on that one. Euro sterling, it's trying to get out of its end of the year into the new year, this whole zone. We're holding the FIB pretty well. We are holding the latest rise FIB pretty well, just 87.80s. I was perhaps expecting, and it's slowly slipping down again from the high print this morning, this euro sterling, coming back around this the top end of the box. We could even put this box maybe a little tighter or so around here. So that's if we get back into it, I still expect more ping pong in around 80, 88. Looks as the 88 is developing like somewhere what we did around 87 for a while. Ultimately, still think this could print a bit higher. The important level for me here is if ever we're going to test and perhaps break 89.10, that's going to be an accelerator, in my opinion. In the meantime, slow going, trading stuff a little bit up, a little bit around a core long there. You've already done the Aussie, right? Right.
No, only a brief view, yeah. If you want to.
Yeah, well, that's okay. Let me go over to some interesting stuff, because the Norges Bank was on it, and let's not forget they are still selling Norwegian kroner every day, and it seems that the NOK buying for the tax reasons that we saw here has dried up a little bit, but it's going to be trading with the oils. Brent is around 80 bucks right now. Yeah, it's if it holds below, this Norwegian krona could weaken a bit, but it has been respecting this trend line. So I want to see what's happening in the euro NOK around 10.58, 10.60, first support here to make a decision. If this holds, I may try to buy a few again for a move up into the high 10s, closer to the 11. If in turn we start to break down, then the whole play may be over. And dollar NOK, that's been is trying to make up its mind, and that could be one to really monitor closely tomorrow. We are turning around this 10.07 zone, 10.10. Try to break above, failure or just making up the counts and see retracing a little bit, managing the positions. Tomorrow, I think 10 is one thing, and then a close above or below this 10.07, 10.09, 10.10. If really we close above this, this may be in for another move, at least another couple of percent, in my opinion. Dollar China, as Ryan was already showing, the as you can see, the 200-day moving average is not really close by here, 686.5, and then the that 50% of the whole move higher, 684. So we're entering a pretty important zone, and if you look at it, we've been trading around here. We've been also stalling here, which was not the 50% yet, but a bit of a trend line over that at that point. But it's still going to be an interesting level here. If ever we start to trade below, could mean bad news. If we hold and we start to get back above mid 690s, I think then we may see the push higher again. Mexico, and I know Horatio also. The question about the Euromex, I'll have a look at it a bit later. But the interesting fact is yesterday, dollar MEX, we broken below this flag when it is below, and then when on the retracement, the recovery, we stopped right on the trend line of the underside of the flag. So keep an eye on that one, around 642, 643 on the dollar MEX. If we have the consumer confidence in Mexico today, and later on the Banxico minutes, monetary policy minutes, so that could be a mover. So keep an eye on this one if we ever recover down to low to mid 1940s. If not, we might be in for a little bit of a retest, 1923, before a retest of the lows. Of course, tomorrow U.S. labor report will probably send a few waves through the dollar mix as well. On the euro mix then, yeah, well, Harry Hindsight says that above 21 it was pretty cold, but if you look at it this way, or a bit too hot probably, I think around high 20s now we have to pay a bit of attention to the euro mix. And the underside is still, we had a bit of a test there yesterday while I was off, and the bounce, the test for me still is 2040s, the low 2040s. If that starts to go and hold below, then I think we are back firmly in a move lower. I'm really very closely monitoring this one. If we see a jump up to high 20s without too much of a reason, then I might perhaps try it again. Let's not forget that Mexico is a 10% interest rate currency, and I can't sell this one for very long. And I'm going to leave it there, Ryan.
Yeah, thank you very much, mate. I just want to have a quick look at oil, because I know a lot of people like looking at oil, but also obviously the relationship with the loonie. Now, oil isn't looking particularly bullish. Got a bit of a range here up towards the 84s and down towards the bid and bid level, down into that 70 area. But it's not looking awfully hot at the moment, and yet we're seeing CAD gain, which when you get that scenario where oil's looking weak but CAD's gaining, then you can almost say that you probably can say with a great deal of certainty that CAD isn't trading the oil at the moment. So it's mainly on the dollar bus, or maybe it's being affected by the yen stuff we've seen moving as well, CAD yen. But dollar CAD isn't looking too hot either. And if we get a break below this 35 handle again, and you can see we've got the 100 DMA sitting there as well, 34.68. So if we get below that, we could be on for a bit of a move south. And as I say, that's going against what oil's doing. You'd expect it to go the other way. So there is a potential that if it does get back on the oil bus, if oil starts moving higher, it could add to this move further, as CAD gets a bit of a bid on the oil side of things. So it's one of these situations where the correlation is a bit weak at the moment, but has the possibility of gaining as well. So just keep an eye on that one. Otherwise, we're pretty much looking at this 135, 137 area range to mess around in, and take your cues from whichever side we break from that. So that was just a quick one I wanted to throw up there. We'll call it a day for today, and say keep an eye on that jobs data later on. We also get the final S&P global services for the US, and I'm not sure when the ISM services, is that tomorrow as well? So let me have a quick look. Yeah, so ISM services is tomorrow after the NFP, so a big data slate to come as well from that. All that remains to say thank you to Kate, thank you to Stel, thank you to all you guys for coming to the Flow Show. Please trade safely. See you all tomorrow.